Welcome to Beyond by Wings, the business side of dentistry, brought to you by Edwards and Associates PC. Join us as we discuss how to build your dental practice, optimize your income, and plan for your future. This podcast is distributed with the understanding that Edwards and Associates PC is not rendering legal, accounting, or professional advice. Listeners should consult with their business advisors before acting on any of the information that is shared. At Edwards and Associates PC, our business is the business of dentistry. For help or more information, visit our website at enassociates.com. Hello and welcome to another episode of Beyond by Wings. In today's episode, we will be talking about the various questions that we get from our clients. And to talk further about it, we have a couple of special guests. One is returning guest / ex-host, Lynne Ledbetter. How are you?
I'm good. How are you?
I'm good. Thank you. And a new guest who's the tax manager of Edwards and Associates. Her name is Lorraine Kent. Yay.
Hello.
Hi, how are you?
I'm doing well.
Awesome. Great. Now, there's a reason why I wanted to have both of you here, because some of these questions will require both of your expertise. Some of them, in my personal opinion, are quite hilarious, but you know what?
Which is why I'm laughing.
And yes, for the listeners out there that don't know, I did share these questions with our guests before we started recording. So you may hear the laughter before the questions are being asked. But in all honesty, I tried putting myself in their shoes.
Yes, they are good questions.
And some of them I'm like, you know what? They're valid questions. I could see myself asking myself that question if I didn't have that business acumen,
Yes. I think the chuckle often comes because we hear these questions a lot.
That's true.
Every new startup wants to ask these kinds of questions.
Right.
What can I do? How far can I go?
Right.
And we get it.
Right. And honestly, in my opinion, it's better asked than, just
assumed. Yeah.
Assumed,
Yeah.
right? So
Right.
I'm glad. And in fact, that's part of the reason why we're doing this episode, so we can bring it to our audience and our listeners as well. So out of these questions that we have here, which one do you guys want to tackle first? Do you think we should go by?
Surprise us.
Good. You can go in order that you have them or
Uh-huh.
random. It's up to you.
Okay. So I think these were random, but coincidentally, the first one does happen to be the most commonly asked question again. So this one is, you guys ready?
Yep.
All right. I just bought a new vehicle. Can I write it off for my business?
That is the most common one.
Yep.
Absolutely the most common one. And sometimes year after year, same business year after year. I just bought another new vehicle. Can I write it off? Oh, I just bought another new vehicle. Can I write it off?
Yeah, that's when we chuckle. If it's the same person asking the same question again. Okay, so, I feel like this could be a yes or a no, depending on the business you're in. Right?
Exactly.
Your industry.
It depends. And primarily depends on what the business percentage
Right.
is going to be. Because if it's used less than 50%, the deductions that everyone hears about, the full write-off, are going to be restricted. You may end up just using a mileage rate. But if your business calls for your vehicle to be used more than 50% of the time, then you may qualify for bonus depreciation or Section 179. Sometimes it depends on which type of vehicle it is. So there's a lot of depends
Yeah, those
in the answer.
Yeah, those catchphrases are what the sales can get you with.
That's right.
You can write this
Yes.
off. You can take bonus on this. You can take 179 on this. And while that is true, there are individual circumstances that play into those decisions and abilities. So there are income limitations. There are mileage, business use percentage limitations, heavy weight of the vehicle limitations. So there's all sorts of things that play into that. And you can't just assume that the salesman is giving you the right answer. Don't rely on your salesman for tax advice who is receiving commission on that sale, right? So yeah, it really depends. And like Lorraine said, it depends on the business as well. Well, we're talking to an audience of dentists. We know what their business is, and we know how much they're driving or not driving. And that's part of the problem. They're not salesmen that are driving all over the place. They're not attorneys that are driving all over the place. So, if they have a single practice, And things are a lot different than they used to be. Like, where are you really driving these days? We own a service business, right?
Right.
Where do we drive? We don't drive to the bank anymore. We don't drive to the post office anymore. We don't very often drive to CE anymore. All of that
You
is
see
done cloud-based, right?
Amazon, everybody delivers.
Right. So, what we could get away with back in the day is going to be different than what we can get away with now. We're still using the old rules because the IRS hasn't said you can't, but we know if it's, as soon as it's looked at by the IRS, they're going to be like, yeah, prove that you drove all those miles, because they see what we see, right?
Right.
So that's where the problem comes
Yeah,
in.
because that back in the day when IRS audits were frequent, when I first started, one of the easy, what I'll call low-hanging fruit, was the mileage log. Nobody could really produce that, and the IRS agent would occasionally laugh at the person who kind of just turned one in and it's all like the same ink. It was obviously written yesterday. So we really haven't had that level of audits in nearly 20 years, actually over 20 years. And we do anticipate that them returning. We know they're recruiting right now and they're training. So we expect to see them eventually next year or so.
Right. And of course, I know there's going to be a handful of people that even though they're aware of the rules, they're still going to try to cheat the system.
Of course.
But assuming that all our listeners would follow our guidance or try to do everything by the book, now, again, validly, if they ask you this, and I say this on par with what you guys just mentioned, which is, well, I use this car to go to work every day. What do you mean? I mean, there's 100% usage, business usage.
Yeah, commuting doesn't count.
Yeah, that's the misconception.
We have even had a case recently where one of the dentists is commuting to another state, opened a dental practice in another state, and that is considered, in the IRS's eyes, commuting.
Right.
Even though
hundreds of miles.
Yeah, it's hundreds of miles. It's involving airfare and additional expenses, more so than just your bonus depreciation on your car.
Yeah,
that you want.
None of that is technically allowed.
And we think we may have a workaround for that to not be his primary workplace.
Right.
Yeah,
but
because we are on your side. As the clients, we are absolutely on your side.
But if that was a primary office and that got audited, the IRS is going to say, no, this is personal. You're going home to visit on the weekends.
I see. Okay. Now, what about someone, let's say, who just started a practice, but to supplement some of the overhead expenses is doing an associateship or two on the side? What about those miles?
That changes things.
Yeah, because then you don't have a primary location.
Yeah, so depending on how much you're working in those other places.
Yes, so if you have a primary location, the to and from that location are not deductible, but anything back and forth and in between would be.
Okay, I see.
To your other locations. Same thing if you have multiple practices. So you're going to have, you may have a primary location. You may not. If you're split all your time evenly, then, you've got kind of more business miles. And the problem also comes in if your primary location is the furthest location, well, then you don't have any, everything is commuting. Because if you drive 50 miles to your primary location, it doesn't matter that your other location is 10 miles away. That's not further. So that's still considered commuting miles. So there are a lot of factors at play and it gets complicated, but just know we do what we can to take the rules to your best advantage, but there are restrictions.
But it is possible if, let's say, someone with multiple locations with one vehicle, if it has usage in multiple locations, that business percentage could exceed that 50% limitation.
Yes. Yeah. When you're getting up there that way, then you can justify it easier. And especially if you've got a lot of associates in those locations, so you really truly are overseeing, and so you're going back and forth, different places every day. Maybe you're filling in for whatever associate was out, or you're going to manage the others. Then that gives you a lot more business miles. And once you hit the 50% mark, if you have the right vehicle, and if you have enough income to allow it, then you're going to get some of those deductions, a full write-off, $25,000 write-off, things like that.
Amazing. Okay. So in short, consult with a financial advisor or your tax specialist before you think, oh, you know what? I should be able to write this off just because my sales associate who sold me this vehicle told me.
And on that note, and I know this isn't one of your questions, but I'm just going to throw this out there.
I think I know what it is, but I'm glad you brought it up because I was thinking
the
of that
sales
too.
associate is also going to say, as you sign on that Tesla, that you're going to get the EV credit, and you are very likely not going to get the EV credit because there are heavy income limitations on that, and most dentists do not qualify.
Okay, so let's actually talk a little bit more about this because I've seen this happen, and it's crazy because in the past, that credit was not already included. This was something you had to apply for, right?
Right.
But now what Tesla or these other electrical vehicle manufacturers are doing is that they are automatically including the credit as they're selling it. So you're thinking, wow, I'm getting this discount because I'm getting the Model Y. It was manufactured in the US, so I get the full credit. But then you're probably a dentist. You're above the income limitations. And what does that do?
And what does that do, Lorraine?
Well, it just started in 2024, so we haven't actually had to work through the mechanics of this, but the rules did change, but where the customer goes into the car dealership and they talk to the salesperson, tells them all the wonderful tax deductions they're going to get on this vehicle purchase, and they ask them a question, does your income qualify? And the purchaser is like, oh, yes, of course, I don't make any money. So then they get the credit. So this is yet to be seen, but I expect it's going to work similar to the, let's call it the Obamacare health credit, where people were getting the advanced credit on the health care, and you'll get a tax reporting form that you received this credit that will be a new form because it doesn't exist yet. So I'm expecting there'll be some new form to report the credit on the purchase of the vehicle. And if your income does not qualify, you are going to be required to pay that back.
So pay that back.
Yeah.
Yes.
So it's going to be added on to whatever tax you were going to pay.
So if you got that $7,500 credit and you don't qualify, your tax just went up $7,500. You got to pay it back.
Yep.
So we need to be cognizant of that.
Yeah.
Yes.
Yeah. We had a client just today. Now, this is on 2023. So he didn't get the advance credit. He was just hoping to get the credit on 23. His income is $9,000 over the limit, and we have tried to get it under, and there's just nothing we can do.
I looked for an hour and a half. There's to be maybe something I can find, and I just could not.
So he's not going to get it. I mean, that's the reality of the situation. But very few dentists are under that. It's not a high threshold.
For American filing joint return, it's $300,000.
Right.
And for single, it's half that. Right. So that's really, for a dentist, especially two earner in this economy, that's really just middle income.
Normal
income, but it doesn't qualify.
Right. One more thing to be cognizant of before, you just accept that, oh, wow, I'm buying an electric car because I'm going to get this credit. All right. Now, moving on to the next question. This one was, I just bought a Rolex as a gift for one of my associates. Can I write it off?
I don't know where the associate's working because I'm going to go.
Yeah, I want to go there too. Well, technically, gifts are limited to $25 per person per year.
Wait, what are you saying? $25,000?
$25.
$2,500.
25.000.
$25?
Or it gets included in wages.
What are you saying? So you're saying that the maximum I can gift someone is $25?
That's the IRS limit on a gift, an annual gift per person.
But
which hasn't gone up in 100 years, I think.
And the employee did happen to be the owner dentist. We did kind of whittle that down.
Sometimes it's the front desk person who happens to be his wife.
Yeah.
Now, sometimes there are guests. There are. Even just yesterday, my husband's coming up on his 15-year anniversary, and his company, every milestone, gives a list of things that they can choose from.
Right.
And so I'd be a little curious to see how they account for it. I'm sure it's getting expense. It's not getting added to wages. But we're talking like, it seemed like the items were averaging about $200 to $300 on the selection. So that That's probably more typical
Yeah.
for your
A Rolex is going to be really hard to
Yeah.
justify.
I know. It's like, just early this year, too, there were a lot of charges in December to Tiffany's on a tax return I was looking at. And I asked for more information on, okay, we're talking like $7,000, $8,000.
Right.
At the time, they were business expenses. But in this case, it surprisingly got returned in January. So, but they were personal deposits. So, but we were like, okay, so bought the gifts, but then returned them. That was a little interesting.
That does sound interesting.
There's always fun things. That
Oh,
we find.
absolutely.
But it's
Absolutely.
like, something $7,000-$8,000, Tiffany's, Rolex, Nordstrom.
Right.
You
Right.
might have to ask a question about that.
Yeah. So, in that case, we're going to ask who
Mhm.
it was for,
Right.
who the gift is for. Are they going to include it in their wages? If you include it in that employee's wages, because there are legitimate gifts, like your husband's gift,
Mhm.
20-year anniversaries, things like that.
Right.
There are legitimate gifts. And if they're going to put them in wages and tax that employee on it, then it's absolutely deductible.
Okay.
But a lot of the owners don't want to do that because they're considerate. It's a gift. I don't want you to have to get a tax hit on it as well. But unfortunately, you can't play both sides of the fence there.
Yeah, the IRS wants to tax everything.
Yeah.
That's
the bottom line.
That's the bottom line.
Sad reality of the situation.
I remember years ago when airline miles, like people who traveled for work and were earning miles on their personal travel accounts, the IRS was dying to try to figure out a way to tax the miles when employees cashed them in on personal trips. And fortunately, they never could figure out a way to do that, and surprisingly didn't require CPAs to figure that out for them.
Interesting.
But that was a big deal for about a year or so, is how the IRS was going to tax like rewards, like travel rewards.
Yeah, so they're looking for every advantage. Don't
Yeah.
think they aren't.
No, that's right.
They've just taken a snooze for about 20 years.
I see. Yeah, no. That's true. They are definitely amping up their audit game. But, the Rolex is definitely on the extreme side.
Sure.
It's mostly for entertainment.
Yeah.
Right? We are recording a podcast. But, in reality, we do see the employer trying to gift, let's say, to referrals.
Right.
Especially specialists. We're working with general dentists just
That's
to
very
make sure.
common.
And it is business related. It's
Right.
to maintain
And a
that
referral
relationship.
fee could be considered ordinary and necessary. That's really the premise of the IRS deductions of what's allowed. Is it ordinary and is it necessary? And sometimes it's not both. Sometimes things might be necessary, but it's not ordinary, depending on the circumstances.
Right. So I would say, in our industry, to pay a fee to the general dentist for referring to the specialist, that is very common. We would definitely consider that ordinary. So if they pay ordinary fees or give them ordinary gifts, that's not going to be any kind of problem. If they were to give them a Rolex, then you've breached the necessary component. That's not really ordinary.
Right.
It's definitely not
right.
necessary. But yeah, there are times when it's a marketing kind of expense. And then the $25 gift rule really doesn't apply in that kind of a situation.
Right. Which makes sense. So like sending a basket of edible arrangements or tips treats or maybe a basket of chocolates.
Yeah. Or even slightly extravagant.
Right.
At Christmas or whatever.
Right,
Yeah.
right.
That's all pretty much
Okay.
industry standard.
Right,
That makes it ordinary and I would argue necessary, because if you don't do it, your competitor is. That makes it necessary.
That's right. So it's part of the whining and dining.
Exactly.
Right. So, okay, that's good to know. Okay, here's another one. And this is a real question, by the way, I got asked. My wife and I just came back from Hawaii, where we talked business. Can I write off the trip?
This is my favorite one, and apparently I have been missing out on a lot of deductions for years. Because my husband is also a CPA, so every trip we've ever taken,
And every dinner you've
and
ever
every
had.
dinner we ever had, businesses come up. One of us has probably talked about our job, but unfortunately, no. If we were audited, that would not be a
An
business
allowable expense, yeah.
No. It's a great idea, though. And a lot of people think just if we go on a vacation and we have a meeting scheduled during that vacation, that makes the entire family vacation deductible. And the IRS, if and when you get audited, is going to say, no, that's a personal vacation.
Right. But
Now,
there are ways, though, to make parts of it deductible. So that's where the strategy comes in.
Yeah.
You don't want to deduct the whole thing and paste a bright red flag on it that says audit this tax return, because I guarantee you if that's in there that's not really allowable, there are other things in there not really. So you don't want to open anything up to scrutiny to the IRS. But if you take parts of it that you can justify, that don't make it scream, hey, this is a problem, then there are ways that you can deduct part of it. Like, you're not going to deduct the whole family. Don't deduct the whole family. But the dentist part, we can deduct that part. We can deduct their airfare, their hotel, potentially, some of the food, not all of the entertainment,
Right.
and not for days and days.
Yes. Right. And like a conference, for instance, is a good example where there's a legitimate business purpose that requires you to travel to get to that conference, where the dentist could book the trip. They're going to need airfare and a hotel. Well, if their family members decide to come along, whether you have 1-2 beds in the hotel, that's not really going to be questioned. So their airfare would be personal, but your entire hotel would be covered.
Yeah, that would
And
be
then, and then a portion of the meals, because you were going to be there anyway.
Right.
So, but if you went to a show on the side, that's personal.
Right. So in order to not be so flamboyant about your deductions, it's better to strategize, take what's allowed, because then, I mean, where else can you deduct a quarter or a half of your vacation? Because that's essentially what you're doing. Don't aim for the 100%, because that screams audit me. But if you keep it reasonable and just to the one portion, then you can deduct that. And that's a pretty good deduction.
Right. And if there is a legitimate business use,
absolutely,
or I mean, a necessary expense to
a component.
Component.
Yeah.
Now, one thing I will caution on that we see sometimes is like cruises and other countries. Now, those would really like to have those questions asked beforehand, because there are very complicated restrictions on cruises and travel abroad.
International.
Even if it is a conference, even if it's 100% legitimate.
Yeah.
Okay.
So
I'm actually glad you asked me this, because, legitimately, there are implant seminars in the Caribbean. They're much cheaper than what you find here. You get more people to, practice on over there. So you're saying that those kinds of seminars would not be?
They could be subject. So ideally, if you're thinking about one of those, go ahead and ask your team lead before you book everything, will I be able to deduct this? Because it does depend sometimes on the country, how long it is.
It's
it's very specific with some of the countries.
Right. I see.
And then there'll be additional limitations. Not that it will be fully not deductible, but a high percentage of it could be non-deductible.
I see. Yeah, and I think we're also talking about two things here, right? One is what raises a red flag, and number two, will it be allowed or not?
Is it specifically disallowed?
Correct. So it could raise a red flag when it is allowed.
Right.
Yeah.
Right. It's just, what is your intent?
Right.
Not to raise any red flags and I think that's what Lorraine's saying, that if you just want to not raise any red flag, then avoid those. Maybe try to find domestic.
Right. The domestic one is definitely a safer option. And then, if we are just reasonable about which part of that is personal versus deductible.
Yeah. Now, if you've got something that is completely legitimate and it can be supported, you just need to understand that it could raise a red flag, but that doesn't mean you shouldn't take it unless you're really adverse to that kind of, stress.
Right.
But if it's defendable, then take it. Absolutely take it. Don't pay tax on something you don't need to pay tax on.
Yeah. Dentists that take several staff members to a conference. And it's very expensive, but they're all actually legitimately attending the conference. So you still have to keep any meals and entertainment pieces of the travel separate because there are different tax treatment. But overall, the trip is a business expense.
Let's see.
So,
Now,
and then the IRS, if you do get audited, there's certain things that require higher level of substantiation, and travel is on that list, of course, as well as meals. Pretty much all business meals are required to have at least one other person and a documented business purpose. And we know most of people are not documenting every meal, who they were with.
I think there's 3 people at this table that are not documenting every
Yeah, no,
thing.
it's difficult.
It
is difficult.
Yeah, you just have to understand that if it gets scrutinized, you're not going to get that deduction.
You could lose it. And and the mileage on the cars, that's actually one of those higher substantiation requirements. So it's up to the taxpayer to be able to prove, if they get audited, the business legitimacy of those.
I see. Yeah. And on that note, I just feel like I need to mention this because it is true. It does get difficult, especially if you have multiple businesses and you're going on these types of whining and dining on a regular basis. It's very hard to keep track of that. But there are software out there. For instance, there's one called Divvy. The way you set it up is that you can actually create limitations. Like any time there's a restaurant charge of, let's say, $20 or more, it's automatically going to send you a text on your phone where you just quickly type up who was there with you, what was the purpose, and the software itself will keep a track of that.
That's very cool.
So, keeping an eye out for technology that's out there to, put into a system that can help you can also go a long way. But as Lorraine was mentioning, it is true. Travel, meals, these are 2 areas that is currently being scrutinized because
it's easy.
It's easy, and they've been abusing them.
Right. Even your just newly trained agent can get an audit adjustment on those because they know most of the taxpayers will not be able to provide the required support.
That's right.
Yeah. And that's the thing. It can all be legitimate. And if you can't support it, it's disallowed.
It's still not allowed.
Yeah.
Right. Absolutely. Okay. Yeah. Great tips there. All right. On to the next one. This one was interesting. I thought this was a good question. I am the 100% owner of 2 businesses. One is a startup and the other has been in operation for over 3 years. I would like to fund a SEP IRA only for myself. Can I just do it through the startup since there are no eligible employees in the startup?
This is an excellent question.
Yes. And this one also depends on the relationship of the 2 practices, but if they fall under affiliated group rules, then they need to be looked at together.
And this one does.
Yes.
From the question it does. So
yeah, most of the time, if it's 100% owner of both, you're going to be
when it's
disqualified.
100% owner and they're both dental practices and same industry, same owner,
right?
They have to be considered as a unit. And this is strictly for ERISA retirement laws so that you can't fund only for yourself and not help your staff.
It's to prevent discrimination.
It is.
It's frowned upon for the owners to solely benefit themselves and not their employees.
Right. And because what you had happening before these ERISA laws, for every little component of your business, you would start a new entity and, those employees haven't been there that long, so I don't have to fund for them. So you might have these large industries, large corporations that were able to exclude the vast majority of their staff from retirement funding, which is not what the intention of retirement is all about, 401ks and things like that. So there are ways to fund for yourself. It's just not going to be tax deferred, tax advantaged. If you want to fund for your staff, you've got to take into consideration all of the rules. And this is one area you really just can't skirt around. There's no gray area. It is what it is.
Yeah.
And in that case, you have to bring all those employees. You either have to fund for them all, the ones that are eligible, or none. You can't exclude any of them.
Right.
And the ERISA laws go beyond just tax compliance.
That's true.
They're their own category as well.
That's true. Yeah. And it's not just for SEP IRA. It's also for
it's all
qualified
retired.
plans.
It's all qualified plans.
Right. Good point.
Okay. Oh, this one. I just bought a 100-acre plot with a single-family residence occupying only about 1 acre of the lot. Okay. The remaining 99 acres is undeveloped land. Now, if I Airbnb that single family residence, can I buy heavy equipment that is needed to develop the remaining 99 acres and write it off?
Mm-hmm. It sounds like a great idea.
It does sound like a great idea.
But unfortunately, the 99 acres portion is going to be considered an investment, and any expenses to develop your investment are capitalized. So eventually you do get to recapture that if you sell at a gain. You get to add those expenses to what you originally paid for it. But in the
Decreasing your gain,
meantime, it will decrease your gain later. But in the meantime, those are not a current deduction. Even if you're Airbnb the house, it's not ordinary or necessary to need that heavy equipment to maintain a rental property.
Yeah, it doesn't matter if it was all bought under one contract. It doesn't have to be 2 separate tracks. You just can't do it. There's no way around it.
What if we try to be creative? We're like, okay, you know what? I'm going to flatten the land, and I'm going to introduce some llamas and horses and
well, then
offer
it becomes
rides.
a farm.
Yeah, the farms
on the Airbnb as a separate package. Like, hey, if you do an event,
the petting zoo part of the
yeah.
Well, then if you, to the extent you can allocate the cost for your pen and your llama, those do become part of the business.
And I doubt that would be 99 acres.
Yeah, right.
But that portion
would be, and it probably kind of really depends. I have not seen a whole lot of Airbnbs with petting zoos combined, but it might make sense to separate those into 2 separate components of activities.
Good point. Yeah.
Yeah, especially if it kind of starts falling under the farming rules, because there's different depreciation rules that apply to farmers.
Okay. Yes. So quite specific.
Mm-hmm.
But I was
quite specific.
I was just thinking, Airbnb, I've been hearing a lot of questions about being creative with Airbnb. I don't know if there's someone out there that's
promoting this
because I got so many questions.
We hear this. We hear strategies go through the dental community in waves.
There's a lot of people right now. I've seen more of it in the last few years than had probably in the prior 10. People buying second homes and Airbnb part-time so that they become a short-term vacation property. And those rules are very complex too. And there's a lot of things that will depend on how many days of personal use you're using the property.
That's right.
Yeah, because we're saying you can deduct the expenses related to the Airbnb, but there are a lot of limitations. So yes, you can deduct them. That doesn't mean you're going to get those deductions. There's a whole set of rules that play into that as well.
And the due diligence part of it is also very different for short-term rentals. You have accommodations tax and, other
yes, it's
registration
treated.
licensing.
You need to
it's not as simple
register as like a hotel.
That's right.
And
That's right.
And for depreciation, it's not considered like a residential rental.
Right.
It's considered more like a hotel business.
There we go. Yeah.
So, but then there are rules that will, depending on the number of days of personal use, if it's over 14, and that includes like friends and family as well, non-paying friends and family, then the vacation rule limits will apply. And then if you jump that hurdle and your personal use is less than 14 days, then you still may be subject to passive loss, because rental activities for most people, unless you're a real estate professional, are not considered active business investments. There's a bucket called the passive activity limit that may get trapped. Your deductions may get trapped at that level.
Right. So all the more reasons to talk with the professional consultant.
I mean, they all get allowed eventually, but that doesn't mean they're going to get allowed in the particular year they were incurred.
Right.
Yeah, they may be just carried over into a future year where there is enough income, or often with rental properties, most likely see them getting released when it's sold. Because once you sell that property, that will release your prior losses.
All right. Here's another one. This I've actually heard quite a few times. Okay, majority of my revenue comes from electronic payments, about 99% of it. But the remaining 1%, which is cash, is it okay if I don't deposit my cash receipts and keep them for petty cash and or year-end cash bonuses for my team members?
I'm trying not to laugh, but we really actually have this problem.
This is a legitimate, real question.
No, you know
Well,
what?
what we hear when we hear that question is not necessarily the intent of that question.
Right.
The intent is, I have this cash, I'm going to use it for my cash needs at the practice. What we hear is, I have this cash, I don't want the IRS to know about it, and I don't want to pay tax on it.
Right.
And some people are on one side of that question, and some clients are on the other side of that question. So that's where the laughter comes from.
That's true.
If you're truly keeping a petty cash account, it would be just like a bank account in theory. The money goes into it, it's deposited, it's accounted for, and then as you spend it, you provide the list of expenses to be deducted.
Right.
And then you replace the cash with the new income.
The problem is that's not
that piece doesn't happen.
Yeah.
Right.
No.
So they keep the cash to use for cash needs, but they don't tell their accountant, they don't tell the IRS, and they don't put it in the bank. And so we don't see the income, we don't see the expenses, and none of that's accounted for.
Right.
And so that is absolutely illegal. There's just no other way to get around that. You can't do that. So, and overstating expenses, of course, is not okay with the IRS, but understating revenue is jailable. So we don't want to promote that kind of behavior.
Right. Would you mind saying that again?
Okay, so if you over-report your expenses, so you make up all these expenses so you pay less tax, that is bad. You have to pay the tax back, you have to pay penalties, all this stuff. But if you don't report all your income, you can go to jail for that. Think of Al Capone, those kinds of things.
Now,
that was jailable. So, we're not generally talking that kind of quantity for our dental practices.
Yeah.
Right.
Some of our dentists have other businesses that are cash intensive. Think restaurants, things like that. Those do rise to that kind of level. So cash needs to be deposited and then pay your expenses out of your bank account. That way, we're sure that we capture the deductions that are legitimate, and you're sure that you've reported everything so you don't go to jail. It's a win-win.
It's a win-win, right? And I mean, think about it this way. Let's say a patient comes to you who's about to pay you. Instead of paying you, right, you're telling them, pay my vendors directly.
Right.
Right. What kind of chaos do you think you'll run into on your practice management software?
It is. It's a mess.
Right. And ideally, put the money in the bank and then you pay your expenses through your bank. You've got the support that you need for your deduction. So if you do get audited, you don't lose the deductions.
Yeah, that's a good point, because we've got clients that do account for their cash properly. They say, hey, we had this cash. Here it is, record it. Here's what we spent it on. Okay, great. But now there are no receipts. So if you get audited, those expenses, here's a tip. The IRS is going to accept whatever revenue you tell them. If you say you made $100,000, they'll say, okay, great. They're not going to ask for that support. But if you say you spent it on something, they're going to make you show that receipt. And if you don't have it because you just gave somebody cash and didn't get a receipt for it, well, you're not going to get that deduction.
Sure.
So that's a problem.
Yeah, and we do have some restaurant clients, and it is an issue we're concerned about with the
specific industries are like that. It's more cash heavy, right?
And
restaurant, like hospitality.
What? It falls under ordinary.
Yeah.
It is within the ordinary to not deposit all your cash and to pay some of your employees or delivery drivers in cash. It's ordinary. It's not really allowed. And you're going to lose those deductions because you can't support them.
Yeah.
And the cash register report tells us what the income was.
Right.
Yeah. So it's not being hidden.
Yeah, it's not
They're
actually
just,
hidden.
You get caught up in the operations.
Right.
Day to day, you're busy, restaurants are busy, whatever, wherever you're working with the cash, you're just working and you're not thinking about all the red tape that you have to deal with and all the support. So you're not dotting all your I's and crossing all your T's, and that's fine. You're getting by. Believe me, I live there myself. Like I just do what you have to do to get the work done. But then it comes to the end and you're like, oh, well, I don't have any of that support. Okay, well, we understand that. And it's normal. But if the IRS looks at it, you're not going to get it.
Yeah, if you're unfortunate and you get chosen, you're
Yeah.
going to lose those deductions.
So we just
So
urge
we'll
people to
allow-
be careful when they can to keep the records.
Yeah, we're not auditors, so we're not requiring every receipt, and we'll take some expenses to the extent of industry standards where X percent is normal, ordinary use of cash.
But
on
back
hand.
to your question, we would urge you to deposit the cash and pay the expenses out
That's
of
the
your bank
recommended
account.
route.
Right.
Yeah, it's just easier. You're going to make your life easier.
It's easier. We don't have to guess or ask questions.
That's
and
right.
Worry if you do get audited, how bad it's going to be.
Yeah, because your accountant is going to know what your revenue is. It comes out of your dental management software. You're reporting that revenue into your management software. It's more than what you put in the bank. That it's easily seen. And by the way, if we can see it easily, the IRS can see it easily.
Don't forget
that. So you're not, you're not really hiding anything. So don't make your life complicated.
True. I completely agree. And then I'm also thinking of a practice that does a lot of cosmetic work. Every now and then you get those rare people that come in with a stack of cash.
Absolutely.
And then you have other reporting requirements, right? You have FinCEN reporting requirements if that one amount is more than $10,000. So if you're like, no, I'm going to keep this for petty cash and whatnot, guess what? You're preventing that reporting requirement and all the more reasons to be scared.
Right. Yeah.
Right. Because then that starts falling into the fraud area, which is where you go to jail.
That's right.
Well, and you've got operational concerns. You keep that much cash sitting around your practice, you're just taunting your employees to steal from you, or losing it, or whatever. So
fire.
Yeah.
And that actually brings me to another point. I don't know, is it just my clients or everyone? Because I've actually heard people. I don't even know if I should be talking about this over the podcast. But there are some people. Let's just say some people that once it gets to that point of a material amount, they're too scared to deposit it in the bank. They're afraid they may get mugged or somebody may know. And guess what? They just keep it in the practice. All that cash.
Yeah. To me, that's a big risk.
Yes.
So to prevent that, as soon as you get them, so don't wait till there's a magic number I'm going to wait for, and then I'm going to do a deposit. No, instead, maybe create a system like every day right after work.
Right.
Or do a deposit drop.
Well,
you go on Wednesdays and Fridays maybe to the bank.
Yeah.
Well, I mean, to prevent fraud in your practice, which is very common in dental practice, 1 out of 6 practices is being embezzled from right now, if you're listening to me. So you should be reconciling your daily production, your daily collections to your bank every day, at least every few days, or at least once a week. Every day is ideal. So if you're holding that cash, you can't tie it out. So your collections say you got $10,000, your bank shows you got $6,000. Where's your other $4,000? Well, you have to just remember, it's in my cash drawer. And then when you get to the end of the week, then hopefully at some point, it becomes difficult to know, wait, did I put that cash in the drawer or did an employee take that? That's what that's why you're reconciling every night and watching those deposits every night to match. So if you're making them not match, that makes it easy for them to also make it not match, and you lose track.
That's right.
And then you get embezzled, and then you're calling us for other reasons.
It's true. Sure. So all the more reasons, just make it easy on yourselves. Just deposit them as you get them, as Lynn mentioned, twice a week, maybe, ideally once a day.
Yeah, ideally every day. It really depends on the cash, the amount of cash.
Yeah.
Like if it was like over $2,000-$3,000, I'm probably going that same day. But certainly at least a couple times a week.
Then you can justify some business mileage.
Right. Help support the mileage.
Good point. Yeah, because that's not commute mileage.
Right. That's legitimate business.
Yeah. Okay. Good point. All right, on to the next question. I just took my entire staff to Topgolf. Well, Topgolf is more popular around here, but it could be a nail salon, a spa.
Yeah.
Right.
We've done all those things ourselves.
Right. Can I write it off?
Generally, yes. If all of your staff is included, it's a staff event. And that is deductible, and it's not subject to the same limitations as other meals and entertainment.
Yeah, it's one of our few things that we're going to not have any qualifiers on. We're going to be like, sure,
all the staff went great.
Yeah,
Hope you had a
exactly.
great time. Yeah, so those are not subject to limitations. And the same if you had an old patient event. Remember, my orthodontist used to have like a party, like an annual party, and so something like that would be deductible, fully deductible, because as long as it's not exclusive,
right,
is when you start excluding people is where you start getting into your limitations,
right, and that's where that discrimination comes in. It's kind of similar to the. Okay, next one. My cash reserve is a little tight this month, and I need some repair work done in the office. Can I hire a contractor to do the work in exchange for any dental work they may need?
So, yeah, there's no rules against hiring and bartering, but you are required to then report that income that you would have charged them. So you would book the income for the service, like the dental services, and then you would have the offset to the expense.
That's right.
Yeah. So it's perfectly allowed.
And then it's allowed, if it's a contractor subject to 1099, it would be 1099 reportable to that contractor.
The contractor probably wouldn't like that part.
Yeah, they're probably
because
trying to avoid that part.
Yeah, exactly.
But if it's over the $600, which most things these days are.
That's right.
Yeah.
That's right. Okay. So, yeah, even though it's possible, it's complex and requires careful documentation. So we usually don't promote it, but is it allowed?
Sure.
Absolutely.
Yeah.
And careful documentation is key
and
here.
as long as you report it correctly, it's totally okay.
Right. And to just highlight a little bit on that, understand this. We're not getting use here fees. We don't have adjustments. You would actually have to create a special code into your software to enter this kind of a barter system income. You have to create a separate profile for this patient because this patient,
it's a real patient.
Right.
It's a real patient.
A real patient, and it will also be a vendor too, which will need the 1099 reporting information.
That's right. And at the same time, the services you're going to provide, the materials that will be used, are you just going to allocate that at cost, or are you going to use the fees from your NDAS schedule? There's just a host of issues that can arise from this.
Right.
So again, completely up to you guys if you guys want to do it. But we ask that you don't.
Makes life a lot easier.
Ash is not wanting to do the extra accounting.
Well, they probably don't want to either.
They'll have to do that. There's a lot of internal work there.
There is. Sometimes it's just easier to just write a check or use the credit card or something. Zelle. I guess people get paid Zelle a lot now.
Yeah. Zelle is getting quite popular. That's true.
Like electronic check, we'll call it.
Yeah.
I do miss check numbers.
You do?
Right?
Yes.
I'm tired of saying draft 1, draft 2.
I don't know. There was just like a ordering to that.
Yeah.
And if one was missing, you knew it. Like you could look for it, like a little lost sheep or something.
Okay. That actually used to bother me because I had clients, in the past when they used to write a lot of checks where they would just randomly pick out a check from the book. And I'm like, okay, I see 1052. Why is the next check 1070? What happened to the other checks?
Yeah. Oh, and then there'd be great answers like, oh, I lost that checkbook. You what? This is not good.
Right?
Where did you lose it?
So, yeah. So there are pros and cons to that, I would say. All right. Let's see. All right. Just a couple more questions, and then we're going to wrap it up. All right. Here's the next one. I own a practice where I do get my business deductions. However, and this is me thinking, how about I assign one of my rooms in my house as home office and then claim additional deductions?
If you have a primary office elsewhere, you cannot do that.
There we go. Short and sweet.
Some of our answers are yes. Some of our answers are no.
Right?
Yeah.
A lot of answers are it depends, but that's a no.
Yes, that's a clear no.
That's a hard no.
That's a hard no because you already have something that is exclusive and where you do your regular business.
Right. If you have a primary business office. Now, the contractors, the associates with no official place, they're the ones who are going to qualify for a home office.
Right.
For somebody in a similar type of profession, like a real estate agent. Often, we've got a lot the spouses,
Right.
real estate agents. They likely don't have an outside office, so then in that case, they
That's
could
right.
qualify.
Mhm.
That's right. Good, good. And the last one for our episode today. I opened a practice about a year ago, and I recently received a letter from the county saying I owe them taxes for something called business personal property. Am I being scammed?
I like these questions. I mean, yes, this requires some education, but I want you to ask me if you think you're being scammed. Don't just assume everything is real. Right now, there's a scam going around about Texas UCC license filings. So scams are real. This is not one of them.
Yeah.
Business personal property is a real thing. It's not a scam.
Right.
You do have to pay it. You do have to report it every year. So what this is a tax. It's definitely in Texas. It's in most states. It's not in every state, where the county primarily is taxing the hard assets of your practice. So your dental chair, your treatments, your cabinets, those kinds of things, your computers, your furniture. They assign a value to those things and tax it on that value. And that's what pays for your school district and your county roads and things like that. So that is a legitimate tax. It is in Texas, and this is common. So I'm going to go ahead and state the Texas rules is you have to render it once a year, generally in the spring. You have to report the assets that you have and the value of those assets. And then the county will assess the tax and send out statements late in the year. Generally, those payments are due by January 31st, but you want to pay them before the end of the year so you get that tax deduction. So yeah, that's a real thing.
Okay. Excellent. That's great. All right. Well, thank you so much for being on our episode today. A lot of valuable information was shared. It was great to have you both here.
It was fun.
All right, thank you.
Welcome to Beyond Thanks for listening to Business Side of Dentistry. Be sure to subscribe to Beyond Edwards and Associates favorite podcast. Join us as we discuss for more information. You can follow us on Facebook, optimize your income, Twitter, and plan for your future. Or reach out to us on our website. You can also shoot us an email and Associates info at legal accounting associates professional advice. Listeners should consult with their business advisors before acting on any of the information that is shared. At Edwards and Associates PC, our business